Welcome back. This is episode 2 of the topic of shares and bonds. Thank you for tuning in. Continue subscribing and sharing our content. Also, give us feedback on what you feel or what you have learned. You can also ask questions. Welcome.
Though you can explain further
Yes.
the advantages and disadvantages of investing in the two.
Yes. The advantages of investing in shares
Yes.
is that once the company grows,
Yeah.
the value of your share grows.
Yes.
So if you had invested at 5 shillings, and so you can find the value of the share price moving from 5 shillings to 20 shillings.
Yes.
The same way, the value of investment will grow.
Okay.
But for the bond, it remains
It is
instant.
constant.
It is constant. It
Yes.
is constant.
Yes.
Then there are times that you see, like the bond, it is very constant that every year of income, if we agreed that the rate of return, interest rate, is 10%, even when that company makes astronomical profits,
Yes.
you just get what you agreed upon.
Yeah, because it is constant.
It is constant.
Cannot change.
That's how you agreed.
Yeah.
A rate of 10%.
Yes.
But for a shareholder,
Yes.
when that company has reported huge profits,
Yes.
he can get very good return in terms of dividends. So there's a year someone can get dividends of, for instance, if you have invested 1 million in a certain company,
Yes.
in a good year, you get dividends of about 20,000. But now when the profits are very good,
Yes.
you get a return of 50,000.
Okay.
If another year is even better, you get 70,000. So
Yes.
the rate of the return that you are getting from your investment keeps changing positively when the company is growing.
It's growing.
But also the vice versa is true. There are times
Now
that
that's the disadvantage. Eh?
the disadvantages of investing as a shareholder,
Okay.
that when the company is making losses,
Yeah.
you don't get anything.
You don't get anything.
You don't get anything.
And in
Because
case the value of shares go down.
again, those are the challenges that you face
Yes.
as a shareholder.
Okay.
Because when the company is making losses, the company is not required by law to give dividends. Actually, it is illegal for company to give out dividends when it is suffering losses.
Okay. It is illegal.
It is illegal.
Okay.
The company can only give out dividends
Yeah.
when it is profitable. But it is illegal for a company to pay bondholders their interest even when it is making losses.
Wow. Okay.
Yeah, the reason why a company is not supposed to give out dividends
Yes.
when it is making losses
Yes.
is because what that would mean, it would mean that company is reducing the share capital it has.
Okay.
And you know, every company is supposed to register with the registrar of companies
Yes.
their share capital. And the information that this company gives to the register of companies,
Yes.
it is public to every Tom, Dick and Harry, to the general public. If today you want to know what is the share capital of Equity as a bank,
Yes.
it is very easy. You just requisition for CRA 12 of Equity Bank. And the CRA 12 is a document that is received from eCitizen platform that gives details about the ownership of that company, who are the directors, where is the registered office of that company, what is the share capital of that company.
So you can
Any company.
You can get the CR12 for any company.
Yes.
From your own account.
From your phone right now. From your phone. You just
Okay.
log into eCitizen account.
Yes.
And from the business registration service, you just follow the prompt and they will be able, you pay 650 to get that information.
Okay.
So when a company pays dividends
Yes.
using
Using the share capital.
Yeah, when it has not reported any profit,
Yes.
where is it getting this money from?
Yeah.
Automatically it's getting its money from the share capital. And reducing the share capital without following the right
The due
legal process,
It
is illegal.
is illegal.
And it's a criminal offense.
Oh, okay.
But it is sad to say
Yes.
that some companies do that
Why?
through a process called creative accounting. And the reason they would do that is because if a company has got a habit of giving dividends at the end of every year,
Yes.
but this year it has suffered a loss,
Yeah.
it would want to avoid making it public that it's actually struggling financially.
Okay.
So to hide or to mask that position, it gives dividends. And people will just assume that since we have received dividends,
It made profit.
it made profit.
But again, it can be entering into a bigger hole.
Into a bigger hole.
Because again, if the coming year, again, it doesn't make any other profit.
Yes. You know, auditors are supposed to be independent.
Okay.
But it is sad. In every profession, we don't lack a few quacks
Yes.
or people who are easily compromised.
Okay.
So such a company, what it would just require
Yes.
is to have an auditor who is not ethical and will actually report a positive cash flow, a positive position, and the company will give out dividends. But in the real sense, what is it doing? It is eating away from the share capital,
The share capital. Okay.
which is illegal.
Ah, okay. That's okay. Now, my final question is, though I think we have not talked about the government bonds,
The
advantages and disadvantages.
Yes, the government bonds. The government bonds, when you compare all forms of bonds,
Yes.
the government bonds is the cheapest in terms of the rate of return.
Cheapest.
Yeah, they
rate
give
of return.
They give the lowest rate of return.
Okay.
Why? The issue, the one that we talked about, risk and return. The
Yes.
higher the risk, the higher the return. The lower the risk, the lower the return.
Yes.
So when you compare banks, when you compare something like the banks, the government, that is
government,
treasury bonds
Yes.
and corporate bonds. Treasury bonds, the rate of return is lower
It is lower.
compared to the corporate bond, because bank is believed that it cannot default on
Government.
the government.
Yes.
I think bank because of CBK, and CBK is the one that is mandated by the government
Yes.
to issue bonds,
Yes.
because the government works through CBK.
Okay.
Now, the government cannot default on its obligations. That is the general understanding.
Okay.
And if in case the bank, the government is struggling to pay that loan,
Yeah.
it can borrow more,
Yes.
like we do here in Kenya. And every other time we feel we are not in a capacity to borrow, we expand our borrowing limit.
Okay.
You remember, even a company, from the memorandum of association of that company, a company has a limit that it should not borrow over, beyond. If a company has a limit that it cannot borrow beyond 1 million,
Yes.
it should not be, if you lend that company more than 1 million, you lose everything that you have borrowed, you have given, you have loaned to that company over and above that 1 million.
So by the time the company is going for the loan, they are
Yes.
supposed to, the issuer of the loan
Yes.
is supposed to
Interrogate
to
that
interrogate-
company.
Okay.
For instance, if I'm a director of Safaricom,
Yes.
and Safaricom, according to its memorandum of association,
Yes.
is supposed to borrow up to 1 million.
Yes.
But me, without interrogating that memorandum of association, I give to Safaricom 10 million. That's okay?
Yes.
So the 9 million will the Safaricom, when they have an AGM,
Yes.
they will say that the director who actually authorized Safaricom to borrow more than 1 million,
Yes.
the 9 million is his personal responsibility. And I will be told, this is not the position of Safaricom, it is the position of the director.
Yeah.
So go ask the director
To
to refund you the 9 million. We as Safaricom, and
the
our
money
documents
was-
are very clear.
The money was used in the company.
Yes. Unless now through an AGM, the mistake that was done by the director,
Yeah.
the Safaricom decides to own it up,
Okay.
and they say, okay, we can see the director actually borrowed to save the company or
Yes.
to pay the expenses of the company.
Yeah.
we are going to revise our terms and conditions on memorandum of association.
Okay.
And we say, instead of putting a limit of 1 million, we'll put a limit of 10 million.
10 million. Okay.
But if they fail to do that, you cannot sue Safaricom.
Okay.
And that's why we are saying the CR12 document is a public document.
Yes, yes.
Before you do business with a company, you have a right to go and check whether what conditions are there.
Okay.
And that's why I was talking about the government.
Yes.
The government, there's a time we had a limit of that we could borrow a maximum of 50 trillion. Then Uhuru's government came through parliament.
Yes.
We extended it. We upgraded it. We pushed it now to 60 million. Again, they revised it again.
Yes.
To 70 million. Now, not 70 million, 70 trillion.
Yeah.
Now it is at 80 trillion. And not because this government wants to continue borrowing.
Yes.
What they will just do, someone will take a motion.
To the parliament.
Usually to the parliament. And one of the MPs. And they'll say, because we need to build infrastructure, to do this and this, we now plan to improve. Now, that's why it is before a country can borrow more, the first step
is to increase the
borrowing power, the limit.
Okay.
Because even that IMF cannot give you money. World Bank cannot give you money because they know. But us here, we do business without necessarily following the right process. You lend to a company and that company didn't have the mandate to borrow a loan of that magnitude.
So you go at a loss as a financial institution?
As the lender, now you will have the opportunity to sue the director at her own personal capacity to repay your money. But the company will have excused itself.
Okay. And again, the director, I think you are entirely to blame, the lender.
Yes.
Because you could have
you did not interrogate.
Yeah.
So the bank, the government can print more money.
Yeah.
Can ask for more loans, and that's why the government it's highly impossible for the government to default.
Okay.
But this other company, you hear, like that time Nakumatt was collapsing, it was saying, hey, government, save us. The government did not do that. There are companies that have always been bailed out by the government. KQ, even Mumia's Sugar, have always been bailed out by the government. So if it is not the government that has been bailing these companies, and you can imagine you had invested in those companies like Mumia's, even KQ, then all of a sudden it is crumbling down. You get a loss.
That's true.
So the government bond, because of that surety, that certainty, it's considered low risk, low return.
Okay. So the only disadvantage
is low risk. Low return. Low return.
That's okay. In conclusion, which one do you think is the best?
Between bonds and shares?
Yes.
It depends, but I would want to say there's an old adage that says that don't put all your eggs in one basket.
Yeah.
So if you have 100,000, I would suggest that 50,000 you invest in bonds and 50,000 you invest in shares.
Okay.
Because they have a tendency of when the value of the bonds is increasing, the value of shares is going down.
Oh.
So for you to be a bit balanced, you invest in both.
Yes.
For instance, when interest rates are going up, like right now, the government has increased the rate, the interest rates that the bank should that any person wanting to borrow money from the bank should borrow at. Initially, the CBR, which is the central bank rate, was at 8%.
Yes.
Actually, it started at 7.5%. It came to 8%. Right now, it is at 8.25%. So what that means is that the cost of borrowing loans is increasing every other day. And it is increasing because also we are experiencing high inflation.
Yes.
You get the point?
Yes.
Now, what happens for a bond investor? For a bond investor, remember, probably you bought a bond, a 10-year bond.
Yes.
And the rate of return is 10% per
Annum.
per annum. So every year you get 10% of your investment. Now, if inflation moves from 8% to 9% to 10% to 11%,
Yes.
you know you agreed with this company or the government that for 10 years
Yes.
they will be giving you a rate of return at 10%.
Yes.
But now inflation is more than what they are paying you. So what happens, the value and the price of the bonds comes down. They lose
The value.
Yes,
not the price, I think the value.
You know, these bonds, it is also the price, because you see these bonds, you don't have to wait for the 10 years to lapse.
Okay, okay.
You can sell these bonds to other investors.
Or you can you withdraw?
No, you cannot withdraw.
You can only sell.
You can only sell.
Okay.
You can only sell through Nairobi Securities Exchange.
Okay.
You say you want to offload. So any person, what happens is, you remember, you have received the rate of return for your bond is 10%.
Yes.
And maybe by the time that that bond was being issued out, the rate of inflation was 5%.
Yes.
It was 2 years ago. And your bond is supposed to take 10 years.
Yes.
Now, inflation has risen
Yes.
to 10%. Now, the bonds that will be issued when the inflation is at 10%, they cannot give rate of return of 10%. They will give rate of return at 12%. So people, investors, will be selling this bond that is giving a rate of return of 10% so that they can buy a bond that is giving a rate of 12%.
Oh, okay.
Because the inflation has increased.
Yes.
And so the bond that is almost the bond which is offering rate of
The best.
rate of interest,
Yes.
which is almost near to the inflation,
Yes.
it loses value.
Okay.
And the newer bonds, they're issued at higher rates to match the inflation rate.
Oh, so you sell the one that is giving you maybe at a rate of 10%?
Yes.
So that you can buy the one that is giving you.
And when you are planning to sell,
Yeah.
every other Tom, Dick, and Harry is
He's
also planning to sell. And the supply for that bond increases in the Nairobi Securities Exchange. And when the supply is high, demand is low, and the price goes down.
Okay. So you might be forced to go on with it. The
Yes.
rate is.
Yes, it's a delicate balance, or it's a hard decision to make. At that time, someone who has invested in shares
Yes.
is not much affected by inflation, because we have seen if it is a manufacturing firm,
Yeah.
or even Safaricom. Let's talk about manufacturing firm. Maybe you are dealing with maize flour. The maize flour, before inflation started, it was going for 100 shillings. Inflation comes, then the maize flour 2 kg packet is going for 200 shillings. They are able to also change their prices, the prices
Yes.
of their goods and services.
Yes.
So they're able to protect themselves against that inflation.
Okay.
But the bond is very rigid.
It is rigid.
Inflation goes up, we agreed. It is 10 years. But when you have invested in shares, if it is for shares for Safaricom, Safaricom can increase the prices of the calls
Okay.
and cushion themselves against the inflation.
Yes.
So, but when it is the other way around, when inflation is low,
Yeah.
then bonds are doing very well,
They are doing
but
okay.
but shares are not doing well.
Why are shares not doing well?
The reason shares are not doing very well, assuming that the opposite of inflation is deflation.
Yes.
When the prices of goods and commodities are very low.
Okay.
So when the prices of goods and commodities are very low, it means even the profitability of these companies is very low.
The profit margin is very low. Okay.
And because the prices are low, there is no good demand for their
yes.
products and services.
Yeah.
So it means also there is no profits. And when profits are not there, they are not able to report and declare and issue out dividends. So the shareholder doesn't get a good dividend or any dividend at all, and the prices of their shares don't grow. Maybe, yes, maybe inflation is at maybe 5%, it is very low. Or the rate of interest is very low.
Very low, yeah.
But the bondholder is enjoying the rate of return of 10%.
Okay.
So the bonds and shares have a way of supporting each other.
Okay, okay.
It's like the way I would advise someone,
Yeah.
and a person who wants to diversify his investments.
Yes.
You invest in products that that do well
Yes.
in rainy seasons, and you also invest in products that do well in summer,
Okay.
in dry seasons.
Yes, yes, yes.
Why is that?
So that when it is raining,
Yes, you are selling umbrellas. And when it is very hot,
you're selling water.
and ice cream.
Okay, that's okay. So it's like, yeah, I think I'd go with that one that you have said. Don't
Put all your eggs in one basket.
Put all your eggs in one basket.
You balance.
Yes, yes, yes. Thank you. Our viewers, we hope that you have gotten something. As for me, I have learned something that I should not put all my eggs in one basket. Please give us your feedback on our YouTube channel. Please subscribe and share. We will be glad to help you and to continue sharing content. See you next time.